thank you for joining us for our third update in this webinar series with James McDonald, Portfolio Manager for the Pengana High Conviction Equities Fund. My name is Luke Deland from the Pengana New South Wales distribution team. I'm actually really excited to be hosting today's webinar, and I can see that we have quite a few people on today's call, and for good reason. James's fund is certainly the most exciting fund in the Pengana stable, and I dare say the best performing fund in the whole country. James is going to share some of his secrets behind his success and discuss the factors contributing to the fund's strong performance, how the portfolio is positioned, and his outlook going forward. The presentation today will run for about 25 or 30 minutes, which will leave us plenty of time for Q&A at the end. I do encourage you to ask any questions that you may have, and you can do so by entering them via the icon at the bottom of your screen at any point throughout the presentation. And with that, I'll hand things over to you, James.
So today I'd like to take everyone over a broad overview of the fund, give you an introduction about the team, investment process, performance, deep dive into a couple of stocks and Q&A at the end, take about 25-30 minutes on the overall presentation, leave some room for questions at the end. For those of you who don't know, Jeremy and I manage the fund. We've both got about 30 years of experience, mine mostly in international markets. Jeremy's more in Australia. I've done a lot in healthcare and technology, Jeremy more in industrials and consumer. It is a high conviction strategy, as the name implies, and it's only got a maximum of 20 holdings. Healthcare has always been a big part of the portfolio, between 40 to 50%. Doesn't have to be, but it's an area I've done very well in, and we understand. It's a defensive growth sector with a lot of technology differentiation, and IT and materials is another area that's featured a lot in the fund. Primarily small and mid cap, doesn't have to be. We've done well in some large caps as well. Can be both Australia and overseas, but I would say nearly all of the holdings are global in nature, with very little touching the Australian economy. It's a mix of both growth and value, but predominantly I would describe it as small cap growth at the moment. It has a negative ethical screen that rules out anything that's harmful to society or the environment. And it's got a very flexible PDS that can hold up to 100% in cash or 100% in stock. We wouldn't do that, and we have guidelines, but as I say, it's very flexible. So what we're trying to do in terms of stock characteristics and strategy is to find companies that have a strong competitive position, and that might be technology, a patented technology, whether that's in healthcare or IT. It could be a strong brand, a low cost of production, a rich mineral reserve. The many aspects. I think most of us have a sense of what makes a strong business. The harder part is to find those businesses trading at significant discounts to their intrinsic value. I would say a lot of the market is fairly valued, particularly in the large cap world. We're more playing in. What we're trying to find is really companies that are a bit under-researched. They might be out of favour or have some hidden value. And that tends to happen more in small and mid-cap stocks. We've just had 4 of our holdings move into the ASX 300 of the 300 largest stocks in Australia, which was a large catalyst, and we feel like we have a couple more that might get there in the next year. And so that's kind of our sweet spot. We do like companies with strong balance sheets that can get them through to value realisation, whether that's clinical study readouts or free cash flow break even. If they have debt, then that they need strong cash flow generation, obviously, to service that. At the moment, I think there's only about 4 or 5% of the portfolio has any debt, mostly strong cash balances. We very much like high quality management teams, and we like those management teams to have high share ownership or be aligned with us. It's not always the case, but we find that management behaves quite differently when they have high share ownership, particularly around capital raisings. You see very different behaviour. Just looking at portfolio construction, we're firstly calculating the upside we think that the company has. then calculating the risk, and that gives us an implied weighting, and we have an implied weighting calculator that helps determine how big a position that should be in the portfolio. The business model, obviously, being you do a valuation. What we're primarily looking at is the amount of free cash flow that a company can generate compared to its market cap, or the enterprise value, which is the market cap plus debt. And we're really looking at 2 or 3 years to try and think about what the earnings potential is then. I think that is quite different to a lot of the peers who are very focused on, current year, current quarter earnings, which, is less relevant for us. Obviously, there is risk in looking out 2 or 3 years, and our job is to know when to trust management, because a lot of companies will make predictions about the future, and you have to do a great deal of research to be confident in that future forecast. And that's really a big part of assessing the risk, is how confident are you in those forecasts in a couple of years' time. Financial risk, I mentioned before, we like companies with strong balance sheets. They're probably the two biggest drivers of risk for us. Most of our holdings are in developed markets, really Australia, US, Europe. We don't have a lot of developed market holdings. I've invested it in Korea and Brazil, but it's not a huge part of the portfolio. The portfolio is unhedged as well, I should say. So looking at some guidelines of the rough shape, we'd like the portfolio to be longer term. This gives you a bit of an idea. Healthcare and materials can be up to 50% of the portfolio, and other sectors around 30%. And there's country limits there, US 60. I believe actually it's now closer to 70% of MSCI World, UK and Japan 30, and other countries 20. The largest position, the guideline is 30%. Our largest holding, Hyperion X, is currently 26%. I will do a deep dive into that stock later. We believe it still could go up 10 to 20 fold over the next 5 years. And so that is a position we would let run above that 30% for a time, maybe up to 40%, particularly if there's any news flow, or just given the upside. I think we're reluctant to sell that one quickly. So just wanted to flag that now ahead of time. And then you can see the risk portfolio guidelines there about how we come up with the position weighting. So low, medium, and high risk, and low, medium, and high upside. There's a matrix of what percentage of the portfolio that stock should be. As I mentioned, when we think about valuation, we're really trying to compare the free cash flow a company generates compared to its market cap. I think if you look at most of the large cap, growth type names, they might generate 1 or 2% free cash flow yield compared to their market cap in the current year. And that's companies that have got good growth, 10, 20% revenue growth. If you've got a zero growth business, maybe like a telco, that might have a 10% free cash flow yield in the current year. We're really thinking about 2 or 3 years' time, and many of our holdings might have a 30 to 100% free cash flow yield, or maybe even more. And so that's what we're trying to find, real outliers in terms of valuation, but we do have to look out into the future. Not every company is valued the same way. If you look at a biotech or a healthcare stock, this is really industry standard practice. The issue with healthcare or drug companies is that you only have a 10 to 15 year patent period. It's a very finite period. You should do a net present value of each drug and then risk weight it depending on where it is in its level of development. So phase 1 drugs don't have a great probability of getting to market, maybe 13%. So you might put a 13% weight on a phase 1 drug, 20% on a phase 2 drug, 60% on a phase 3 drug. And there's a final risk of approval where you've got to get it past the regulator. So you don't give it 100% until the FDA has given it the tick of approval and you've made it to market. Looking at our performance, really delighted to report to you that we're now up 108% over 12 months. And as Luke said, I believe we're the best performing fund in our category, at least on the Morningstar site, out of 70 funds over 1, 3, and 5 years, which is really very satisfying. We have had down periods, particularly in 2022 when interest rates rose. So thank you to our investors for sticking with us then. Looking at some of the contributors to performance over the last 12 months, Clarity Pharmaceutical has been the real standout, up ninefold or 800% in 1 year. That's contributed almost half the gains of the portfolio over 12 months. We have reduced the holding in Clarity by some 70%, but it is still 10% of the portfolio. Hyperion X has also been our largest holding, and an incredible performer, up sort of threefold in that period. And Opthea, a drug for wet-aged macular degeneration. I don't have the exact number off the top of my head, probably another 100% on that one. And Brazilian Rare Earths also up more than 100% over the last 12 months. So some really great contributors, and I'm very grateful to the management teams of those companies for making that happen. On the negative side, we have had some detractors, but I think in the overall scheme of things, in an up year when we're 100%, all fairly, small in the larger scheme of things. Healthcare has been the big area of contribution for us. Average weight over the last 12 months has been 48%. We're up on average 76% in our healthcare holdings. Materials have been 33%, where we're up 40%. I think just over in the overall positioning of the fund, we have about 45% in, I think, companies that will benefit from geopolitical uncertainty, and about 45% in healthcare, which should be quite defensive. A lot of our holdings are quite early stage, so probably not fundamental. May not appear to be extremely defensive businesses, but if you look at the underlying fundamentals of the company, I believe it is actually defensive industries and sectors. We have added probably about 25% of the portfolio is invested in companies that we've added over the last 3 months. So we're always trying to recycle some positions and find new things, and added several new small holdings that we're not really wanting to talk about yet, but a couple we'll talk about today. Hyperion X is the largest holding in the portfolio, and is our highest conviction idea, currently about 26% of the fund. We started investing in this company in March 2023. I think we've now participated in 3 capital raisings and spent a lot of time researching it. It's very interesting because the US currently doesn't produce any titanium metal. It consumes about 25% of the world's titanium, but doesn't produce any. And most of it's produced in China and Russia. So there's this urgent need to really reshore titanium production back to the US. The company has a highly patented disruptive technology to lower the cost of producing titanium finished products. It's zero carbon emissions, unlike the current process, and is recyclable, and the current process isn't. It's a very experienced management team with high share ownership. For those of you who don't know, titanium really is the wonder metal. It's much stronger than aluminium. It's lighter than steel, and it's more corrosion resistant than stainless steel. So if the cost was lower, it would be used in a lot more applications. Aerospace is a big user of titanium at the moment because of its lighter, high strength, lightweight nature. Interestingly, carbon fiber corrodes aluminium. So there's a reason that a lot of the new aircraft have a high content of carbon fiber and titanium. We've also seen titanium pop up in things like consumer electronics products with all the high-end smartphones from Apple, Samsung, and the Chinese operators using titanium cases for its strength, and starting to see it being used in sectors like autos. I mentioned before that China and Russia produce 70% of the world's titanium. US is getting most of its titanium from Japan, which produces 20%, also some produced in Kazakhstan. But Airbus, for instance, in Europe is still reliant on Russian titanium, which seems extraordinary. So there is this great need to reshore production to the US that doesn't produce any. It's a tiny market because of the high price. So we're hoping we can get the price down and eat into the much larger aluminium and stainless steel markets in time. So just to, excuse me, just to dwell on why Hyperion X can make titanium so much cheaper than the existing process. This is a slide that really gives you a good insight. The existing Kroll process takes titanium mineral sands, which are rutile and ilmenite. Most of that, out of interest, goes to make titanium dioxide, which makes paint white. Something like 90% of titanium minerals are used to make paint white. About 10% is upgraded into titanium sponge. And that's a process where you heat it up to 1300 degrees, add chlorine, then add magnesium to strip off the chlorine. Then you have to heat it up again to 1800 degrees, even higher, melt it a couple of times to get rid of all the empty spaces, the pores. And then you roll it and mill it down and eventually use a drill, a CNC lathe, to get it to the end product. Titanium bonds very strongly with oxygen, which is why it's a great material, why it's so corrosion resistant, but it does make it extremely difficult to work with. And every time you go through the existing one of these steps with the Kroll process, the current process, you're losing titanium metal, which you can't recycle. You've got to go right back to the beginning, and particularly these are alloys of titanium. So you've got to separate the metals out, go right back to the start and start all over again. So the end product, you end up with only you lose 85 to 95% of the titanium metal in making a product. This product, we can use scrap, which there's an abundance of because it can't currently be used, or we can use minerals. That turns into a powder, and then we can press that powder into these shapes that look much more like the end shapes we need. You can see a bolt there on the right-hand side. And the end of it, we might lose somewhere between 20 to 50% of the product in making it. So that is the fundamental difference why this is so much cheaper. Also zero carbon emissions, as I mentioned before, so much better for the environment. I think I've probably touched on all of these points. This here is pressed into a shape that could be used to make a watch. Some of the high-end watch companies are now making titanium watches. The very nice thing, they've just finished their factory in Virginia. They've tested the furnaces 2 months ago, working perfectly. In fact, the oxygen level is much lower than the oxygen level on the existing technology. So it's extremely high quality and can replace all the existing titanium being used. It won't initially be targeted at aerospace because it's very long lead-in cycle, test cycles, really targeting applications where it can go faster to market. Just announced a contract with a auto supplier. What really excites us, though, is the current market cap's around $600 million US. Their initial plan is to get to 2,000 tonnes by the end of 2026. And that plan is $125 million US of EBITDA. So about 5 times, 6 times EBITDA. We think there's scope to improve those numbers, selling at a higher price. But The US is currently using 100,000 tonnes of titanium per annum. That plan is just 2,000 tonnes. So the company is hoping to get to 10,000 tonnes by 2030. Maybe EBITDA at that point will be $500 million or $1 billion. The main competitor, Howmet or Comp, for valuation purposes, trading on 20 times EBITDA. So you could imagine a company that might be $10 billion US or $20 billion US compared to the current 600 million. So I think that gives you an idea of, why we're so excited. A lot of government funding opportunities coming up too, which I think will provide the necessary funding, not necessarily having to tap shareholders. Brazilian Rare Earths is another large holding in the company, in the portfolio, about 11% of the fund. Current market cap around 700 million, and it's discovered by far the richest rare earth deposit in the world, probably the largest, that's got significant byproducts apart from rare earths. Maybe just to step back a little bit, why do we need rare earths? Rare earths make the lightest, strongest magnets. So if you want to use EVs that have long range, or you want to have offshore wind turbines that are light and float well, or you want robots that are dexterous with good battery life, you need rare earths. And they account for those three applications I just mentioned account for about 25% of the rare earth market, but they're growing very rapidly. Rare earth prices are currently extremely weak because of the weakness in the Chinese economy, in the other 75% of rare earth demand. And the Chinese have been flooding the market with increased supply. But from the 1st of October, there's been a change of Chinese government policy to restrict supply. But irrespective, it really doesn't matter, because this company is going to be enormously profitable even at the current prices. It's going to be like a mining company with software-like margins. So and I'll touch on why in a minute. Management team very, very competent with high share ownership. Gina Reinhart's Hancock Prospecting owns 6%, as does Whitehaven Coal. So why is it going to be so profitable? Well, if you look at the top line, the average grade of their intercepts is something like 18%, but they've got holes with intercepts of up to 40%. It's a huge tenement, 1,800 square kilometres, and they're currently in the process of drilling it up, finding the richest locations and mining those. So we still don't know exactly where the average grade's going to end up, but it's quite possible they have grades of more than 20%. Lynas just updated their resource. Lynas is the richest rare earth company in the world at the moment here in Australia, $7 billion company, updated their resource to 6%. Mountain Pass in the US, $5 billion company, 6%. So, we're talking about 3 times higher grades. We also have byproducts of a lot of other metals, scandium, tantalum, niobium, and uranium, which just the byproducts alone would pay for the processing of the rare earths. So in actual fact, the rare earths are kind of for free, if you like, which is why I mentioned the margins could be so very high. 700 million market cap. These are Canaccord estimates, but this is a company that can generate $1 billion a year of EBITDA, probably in 3 or 4 years. They can do a low-cost small mine in 1 to 2 years, and then a couple of $100 million of capex to get us to this $1 billion free cash flow mine. So I think once again, this is another company that over if we hold it for 3 to 5 years, might be a 5 to 10x return on the current share price. Greatland Gold is a company we added a month ago, and we've made a 40% return. It's a UK-listed company which will relist and re-domicile in Australia, where its main asset is in northern Western Australia. The Havieron deposit, $1.6 billion market cap. We think, looking out to 28, it's got the potential to make $500 million of sort of net profit per annum. That's, you can see it's going to be one of the lowest cost gold producers in Australia, one of the largest producers, and And we think when it relists in Australia in the next 6 months, it will very quickly go into the ASX 300 and the GDX index of large gold producers. I won't go into too much of the corporate history other than to say the mine, there's an old mine here called Telfer that is 45 years old, owned by Newcrest. Newmont bought Newcrest last year, and they're in the process of selling off their small mines. So this Telfer mine's got 15 months of production left, although that can be extended. And then the Havieron deposit is going to start in a couple of years, in probably 26, 27. And it's the very low cost large mine that will cost about $800 million to develop. But the Telfer mine will fund a lot of that CapEx via production for the next couple of years. So a nice mix of short-term and long-term production. Looking at the Havieron deposit, it will be one of the largest. This is millions of ounces of gold contained in the mine. You can see Havieron here will be the second largest gold mine in Australia. It will be one of the largest by production, the fourth largest by production. We're actually very hopeful that that production number can be substantially higher than 268,000 ounces a year. The grade is 3.4 grams per tonne, which is one of the highest grade gold deposits in Australia. And this is cost, the all-in sustaining cost, which is kind of the fully loaded cost, including CapEx, will make it one of the lowest cost gold producer, or the lowest cost gold producer in Australia. Up here is where it appears in the global, it's in the lowest quartile of cost of global gold mines. So very nice if you get a downturn in the gold price, the company's well protected. There's just some timelines there. I probably won't go into that now. One final healthcare stock that we're quite keen on. Actually, the market cap's down to 140 million. It's had a weak couple of months of performance. $40 million of cash. This company has developed a gut bug test for a PCR test for 8 different types of gut bugs that cause 90% of gastrointestinal problems in the US. The current test involves a stool sample, which is sent to a lab. A scientist peers down a microscope and tries to spot the microbes, which is not very accurate. It's only about 60% accurate. It takes 4 or 5 days, and it's very unprofitable for the labs because it's very labor intensive. This test can turn around in 1 to 2 days, 90% accurate, and it's very profitable for the labs. So we think it's going to quickly displace the $500 million of existing tests in the US. The first year might be a bit slow, just getting everything in place, or we expect a small amount of revenue in the September quarter that's just gone, and every quarter sequentially after that to ramp up. It's actually quite a consolidated lab market in the US, where the top 2 players, LabCorp and Quest, have 40% of the market. So you don't have to actually get into many companies to penetrate the market. There's also $20 million of flu and COVID testing revenue in Australia, which is a nice base business. Just appointed the head of Roche Australia as the CEO last month, and the current acting head of and director of the company was head of Roche's global diagnostics business. And Roche is the largest diagnostics business in the world. So very skilled management team who really know what they're doing. So with that, I will throw it over to questions.
Thank you, James. That was a very thorough update as always. I can see that we've had a number of questions that have come in, but just a reminder to those on the call that if you do have any questions, we still have some time, or you still have some time to enter them into the Q&A box at the bottom of your screen. But the first question, James, I've got here is, the fund has had such an exceptional period of performance, but for investors starting to allocate today, have they missed the opportunity?
No, it's a great question. And I think really, as I mentioned, the biggest contributor over the last 12 months has been Clarity Pharmaceutical, which has been fantastic, as I mentioned, but we have reduced that position in the fund down to about 10%. There's a whole bunch of other companies that have really not moved greatly. I mentioned before, Hyperion X, we think is a company that can still go up 10 or 20 fold. It's up three, which sounds like a lot, but we do have history in this area. I think we invested in Telix in 2019, and it's now up 20 fold. So, and Clarity up ninefold. So it does sound like a big claim to say we think these things can keep going another 10 or 20 fold, but I really believe that. And hopefully some of the other holdings that I just ran through gives you a bit of a sense of our excitement going forward.
Okay, thanks for that. And just sort of sticking to that topic of performance, has something changed with your strategy, and are you managing money differently in order to generate this kind of upside?
Broadly, no. I would say we've concentrated the portfolio perhaps more than it has been in the past. And I think we've really, it's always been global. I think we have concentrated down into global businesses in Australia where we have good access to the management of the companies, which is obviously important. If you're going to be taking concentrated large positions, you need to do a great deal of due diligence as part of doing that. And we've been very fortunate in to have had great access to the management of our holdings. I think that's probably the main thing. As I mentioned, healthcare has always been 40 to 50%, and it still is. And so, yeah, perhaps some nuanced changes, if you like.
Yeah. Thanks for that. Just on the topic of holdings, the next question I've got here is, how many stocks are currently in the portfolio, and what is the weighting of Australia to global holdings?
Yeah, so currently 15 stocks in the portfolio. Australian stocks are about 85% by domicile, but many of them, so Hyperion X is dual listed, and we hold 15% of it in the US and 10% in Australia. So by listing, I think we're about 30% in the US and 50% in Australia. I should have that exact number. But if you actually look through to the underlying risk in the portfolio, the only company that touches Australia is Greatland Gold, which is about 8%, and all the other 92% is international.
Okay. There's actually a follow-up question to the one I just asked as well. And in relation to the holdings globally versus Australia, how much of the revenue is generated locally from these Australian listed stocks?
Yeah, well, I think that goes back to that point, which is really just Greatland Gold having been about 8% of the portfolio, being really, look, there would be a small amount or particularly if you look at something like Clarity, I suppose there's no real revenue, but an embedded, Australia tends to be a couple of percent of the global healthcare market. Genetic Signatures right now has a high weighting of Australian revenue, but really longer term, I would say 90% of the value of Genetic Signatures is US. And I think that's really just true. As soon as you're investing in healthcare, because the reimbursed prices in America are so much higher than anywhere else in the world, very naturally, the value of the companies tends to really be in America as well. But probably, I imagine if you looked at any global healthcare company, something like 60 to 70% of the value would be in the US.
And just earlier in the presentation, James, you touched on obviously the top performing stocks in the portfolio, but you also mentioned a couple of the detractors. Could you perhaps take us through some of those detractors and your obviously outlook or their future prospects for those stocks that you're holding in the portfolio?
Yeah, sure. So Alta Global it was the largest detractor, is a gym management software company, sort of like CRM software for gyms, and they're very much focused on the MMA market, mixed martial arts, and they've just signed a very interesting deal with the UFC, who's going to distribute their software. The UFC actually owns about 750 gyms, and Conor McGregor's the famous UFC fighter who's starting to promote and become a significant shareholder in the company. So quite a interesting outlook on that company. Probably something that is impaired and we have exited is Meyer Burger, which is a German solar cell manufacturer. And that it's sort of interesting because Australia is talking about bringing solar cell manufacturing back to Australia, which just seems absolutely ridiculous after our experience in Meyer Burger. But that had a leading differentiated technology to make solar cells in Europe. And, China currently produces 70-80%, and then they've outsourced, some to Southeast Asia, but, 95% of the world's solar panels are produced by Chinese companies, whether in China or Southeast Asia. The US has put on tariffs and subsidies to bring solar cell manufacturing back to the US. The German and European governments were talking about doing that. They didn't. So Meyer Burger is now packing up all its factories and moving to the US. But look, it's fundamentally a tough market. I think we underestimated the Chinese competition and we did exit that holding. And Terrace was a heart valve company. It is very interesting. We have exited that just because it continues to need more capital, and we've actually bought into another interesting company. We're not ready to talk about that yet. So just sort of rotating between names there. I think Anteris will be a fantastic long-term investment, but they're probably not going to get to market until 28 or 29. We've had a fantastic investment in Opthea over the last 12 months, but that is a company we started investing in about 3 years ago, and we've participated in 3 capital raisings. And I think the moral of the story is you can be too early in some of these healthcare names, and you can underestimate the amount of capital that's required to get to market. So you do need to be a little bit cautious.
Thanks, James. And I'll take a couple more questions in the interest of time. And these last two are both in relation to IPX. The first question is, what is the reasoning for owning Hyperion X in both Australia and overseas?
Yeah, look, another good question. The real history, we used to have a 20% limit on how much of the fund could be invested in Australia, which we lifted. As I explained to you, it really is still very much a global portfolio with a lot of companies listed here. So you can actually switch listings. They are fungible, so it takes a couple of days and it costs a couple of percent. But it's actually quite nice having some liquidity in both markets if we wanted to sell, which we absolutely don't. We can participate in 2 different pools of liquidity if we wanted to exit.
Okay, thanks, James. And just lastly, what are the risks to the Hyperion X stock thesis that you discussed in today's presentation?
Look, I think it's probably similar across a lot of our holdings, as it's just time and how long. Bit of execution. We know for IPX, I think 25 is very much a year of prototyping, supplying material to customers, getting the factory up and running, and it all humming. And then as we get into 26, we really hit our strides, getting some huge, getting production up to a more substantial level, hopefully free cash flow break even. But yeah, I'm not worried technically. I believe the furnaces have really been tested, which was the key technical risk, was to scale up to using larger furnaces. And they just tested that, as I said, last month, and showed that the oxygen content's incredible. So I think just how long, and it always we've just got to be patient. I think that's the hardest part of being an investor sometimes is just patience.
I agree. Thanks, James. Well, in the interest of time, I'm going to wind things up here, but thank you to all of those who submitted questions. We obviously weren't able to get through them all today, but for those of you who didn't hear your question or a version of your question, we will respond to you directly. But what I wanted to say is what I really took out from today's presentation is that notwithstanding the sensational run that the fund has obviously had, there's still actually many more exciting companies and enormous potential for our performance ahead going for this fund. And I'd also like to mention that this strategy is actually capacity constrained, and we restrict the capacity so James can continue to invest in small companies and that the returns generated have a meaningful impact on the fund. So we'll probably raise another 20 or so million dollars, and then we'll be closing the fund to new investors for the foreseeable future. Our next webinar in the series will be next Tuesday, the 8th of October at 12:30 p.m. with Steve Black, co-portfolio manager for the Pengana Emerging Companies Fund. Please RSVP for that event if you haven't done so already. But with that, I thank you all for attending and enjoy the rest of your afternoon.